Hello and welcome to my channel. Before starting, support the channel by liking this video and subscribing to this channel for future updates. Today we're going to talk about expert insights, interviews with economists and financial analysts on the dollar's future. U.S. financial market conditions are a source of concern. While the Federal Reserve and the U.S. Treasury have successfully stabilized financial markets, following the collapse of a handful of medium-sized banks, the Fed is worried that the crisis will create enough of a credit crunch to slow the U.S. economy. This is according to the Fed's latest report on financial stability. In addition, the Fed's survey of banks indicated that they intend to tighten lending standards in part due to fears of deposit flight. The Fed's report on financial stability found that despite decisive actions by authorities, the bank crisis could undermine the economic outlook, credit quality, and funding liquidity, and could cause banks and other financial institutions to further contract the supply of credit to the economy. It also said that a sharp contraction in the availability of credit would drive up the cost of funding for businesses and households, potentially resulting in a slowdown in economic activity. Meanwhile, the Federal Reserve's survey of bank loan officers found that the share of banks that are tightening lending standards increased moderately from January to March. However, the latest survey was taken only shortly after the collapse of Silicon Valley Bank. It is likely that the next survey, which will be released in July, will indicate the degree to which the crisis has affected bank lending intentions. The irony of all this is that the crisis in the banking system is mostly in the minds of investors and depositors. There is no systemic problem in the banking system, at least not one that should lead to a seizing up of credit activity. It is very different from 2008 when excessive leverage led to a near collapse of the banking system. This time, a handful of medium-sized banks with roughly $500 billion in assets and a system with $23 trillion in assets failed, in part when depositors got scared and moved their money elsewhere. This in turn led to a larger exodus of deposits from smaller banks. The shrinkage of smaller banks means less ability to deliver credit to small and medium-sized businesses, thereby hurting the economy. Sheila Bair, a former U.S. bank regulator, said that the turmoil is overblown and that there is no crisis unless media hype and short-selling pressure undermine confidence so that depositors flee otherwise health banks. Although the banking system remains relatively safe, there is a problem involving the balance sheets of some medium-sized banks. Many face troubles due to excessive exposure to commercial property, especially the market for office buildings as well as non-grocery shopping centers. This is exacerbated by higher interest rates. Following the pandemic, many office workers continue to work remotely, leaving many office buildings only partially occupied. Many companies are gradually reducing their office footprint. Consumer online shopping accelerated rapidly during the pandemic, a trend that has not reversed. This has rendered many retail properties troubled. The result will likely be a decline in office building and shopping center revenue, and greater difficulty in servicing bank loans for office and retail construction. There will also likely be a tightening of lending conditions for office space and shopping center space on the part of banks. Two possibilities emerge. First, some banks may face problems, potentially requiring rescue by authorities. This could have a further negative impact on credit conditions. Second, troubles in the property market can have a negative impact on construction activity and the range of industries that supply the construction industry. Still, there might also be opportunities to acquire property inexpensively and repurpose it. U.S. inflation heads in the right direction. Investors were likely relieved when the U.S. government reported that inflation continued to decelerate in April. There had been concern that the progress seen since last June might be reversed. That fear was exacerbated by the fact that progress was indeed reversed to the Eurozone. Instead, U.S. inflation did continue to ease. On the other hand, core inflation, although falling slightly, appears to be more persistent. Let's look at the numbers. The government reported that consumer prices were up 4.9% in April, versus a year earlier, the lowest rate since April 2021. Inflation had peaked in June at 9.1% and has been declining ever since. Consumer prices were up 0.4% from the previous month. Core prices were up 5.5% from a year earlier, down from 5.6% in March and the same as in February. This was the lowest rate of core inflation since late 2021. Still, core inflation has been in the range of 5.5%–6% since November, receiving much more slowly than headline inflation. Meanwhile, energy prices were down 5.1% while food prices were up 7.7%. Inflation appears to be sustained by the sharp rise in the price of shelter, up 8.1% from a year earlier. This reflects the lagged impact of last year's sharp rise in home prices. However, April's shelter inflation was slightly lower than in March. Thus, shelter inflation appears to have peaked. Now that home prices have declined, it is expected that the shelter component of The Consumer Price Index will continue to recede throughout this year, thereby helping to further reduce inflation. In any event, if shelter is excluded, consumer prices were up a modest 3.4% in April versus a year earlier. Consumers purchased three types of categories: durables, non-durables, and services. Prices of durables were down 0.2% in April versus a year earlier. This reflects weak demand for durable goods combined with improvements in supply chains that deliver such goods. Prices of non-durables, less food, were down 1.3% in April. Prices of services, less shelter, however, were up 5.2% in April. Thus, the persistence of inflation is largely related to trends in the service sector. Finally, some categories saw sharp price declines in April. These included the following: car rentals, down 11.2%, used cars, down 6.6%, health insurance, down 15.8%, and airline tickets, down 0.9%. The bottom line is that goods inflation has largely disappeared. To the extent that inflation remains persistent, it mostly has to do with shelter and other services. This likely reflects consumer demand, shifting sharply away from goods and towards services now that the pandemic is over. Going forward, given that the economy is weakening due to Fed tightening, it seems likely that inflation will continue to decelerate. From the perspectives of the Federal Reserve, the inflation report is favorable news and increases the likelihood that interest rates will be kept steady. This expectation explains the rise in equity prices following release of the inflation report. However, the Fed has indicated that its decisions will be data-driven. Thus, future decisions will depend, in part, on future inflation data. The latest on China. In recent months, much has been written about the tense relationship between China and the United States, especially given U.S. export controls and China's threats of retaliation. Now it appears that the relationship between China and the European Union, EU, is becoming more fraught. The EU is proposing sanctions on specific Chinese companies that are said to support Russia's war effort. This would be the first such measure by the EU to sanction China. In response, China is threatening to retaliate. A Chinese official said that China is not supplying any weapons to Russia, and that economic relations between China and Russia are normal. Moreover, he said that we are against states introducing extraterritorial or one-sided sanctions on China or any other country according to their own domestic laws. And if that were to happen, we would react strictly and firmly. We will defend the legitimate interests of our country and our companies. Thanks for watching.